lights. Tim, did you give these out? Did everyone have the little handouts?
Yes.
Okay. I touched on some of this last week, and I mentioned that I was going to. And I mentioned that I was going to have more of a presentation today and give you copies. I also have the slides available that I can send to Jenny or Mary to email out to you if you're interested. This first sheet, and I believe it's the last sheet in the little bundle of items that you have stapled together. This is information that was put together and put out by the Mortgage Bankers Association. And this shows a finance forecast, and this is as of June 18th, so this is very recent and current. And of course, 2014 is showing you the history. The things I wanted to touch on today and point out that I thought you would find, most interesting, it shows the housing starts through the first 4 quarters of 2014 and then through the first quarter of 2015. And this is for single family and 2 or more, and these are in the thousands. So the first quarter of 2015, and nationally, there were 975,000 new housing starts, which is, this is a great increase, of course, over a few years ago. If you look down in the existing home sales, and again, this is in thousands, so that's actually 4,677,000 in the first quarter of 2014, jumped up to 4,973,000 home sales in the first quarter of 2015 nationally. And then you can see right below that it says how many of those were new homes. Down here I want to touch on the interest rates right here. This shows you the interest rate history for 2014. And you can see in the first quarter of this year they dipped. I mean, they were below 4 again for a while. And they're still hovering around 3.9 to 4.125% for the second quarter of this year. And then you see they're forecasted there to go up to an average of 4.3% and then 4.5%, kind of a forecast for the rest of this year. And then you can see they're forecasting, they're trending upward more in 2016. We're going to see on some slides in a minute that, they've been forecasting rates were going up and we've still stayed below the forecasted rates. Don't know if at this point we are really going to hit these higher rates, but that is, I think, still the current prediction. This is, again, more current data than what is on some of the other slides I'm going to show you in a moment. This last section down here is mortgage originations, and this is in the billions. So for the first quarter of 2015, nationwide, there were 313 billion mortgage loans originated. You can see right here, 175 billion were actually refinances the first quarter of this year. So that was 56% of loan volume. And I wasn't doing 56% of my business as refinances, but probably 25% or so was refinances. So we had another big hit the first few months of this year. I actually have 2 refinance closings this month too, but they're starting to taper off. And you can see here that trend towards the end of 2015 and into 2016, that's going to be a smaller percentage of the business because the mortgage rates are predicted to increase. So most people will have refinanced by this point, if they've got a higher rate, since rates are lower right now. All right. And then we've got to go to the other section. Okay, and then the next part that I'm going to go through, I've actually had to send the whole slideshow here because I couldn't break it up. I think that's the last page of it, isn't it? Yeah. But we're going to just go over the pages that I've given you because some of this I didn't print out for you, obviously, the cover page. But to let you know where this came from, this was actually prepared by Morgan Stanley for the Mortgage Bankers Association. And I touched on this last week. They're showing, again, overall, U.S. economy showing signs of improvements. Interest rates are still very low, but they are predicting an upward trend. One thing I thought was interesting, they're talking about the household formations are on the rise. One of the slides we're going to look at in a moment kind of shows you where they were and where they're likely to trend. And then you've got a significant segment of the population that are entering the age to be home buyers, which is the group everyone calls the millennials. And also home affordability has improved because rates have been so low, but they are going to be impacted by the rates. So it is going to decrease the amount of purchase power a buyer will have as the interest rates go up, and I do have a slide that will show that in a moment. The $1 million and higher home price segment has actually experienced the largest year-over-year increase in the number of mortgage transactions. So for a while, we weren't having as much activity at that price point, and that has increased.
Are those new homes or are those refis?
Those would not have been refis, that would have been, purchase transactions, yes.
Okay.
Because this is talking about
Right.
buying power and purchasing. Okay. I'm not gonna, this isn't one I was gonna go over. This is one I think you would find interesting. This shows you the historical rates right here. And the dark line is the Fannie Mae 30-year mortgage rate, which is what your average home buyer is going to be getting when they purchase a home. And you can see it's been running a little bit higher than, of course, the 30-year Treasury rate, which it's always going to be. But they've been running, right here together as they go up and down. So this is where we are. And then when you look over here, this shows the mortgage rate forecasts from March of 2015 to December of 2016, and the darker line right here is what they were forecasted to be, and then this is where they actually have been. So see, they've been trending. This is where they were forecasting for us to be at this point, and they're still down here. But they are still predicting them to go up. I don't know if we'll stay below that like we have been or not, but just gives you an idea of where we have been running with actual rates versus the forecast. Okay, this is another one that actually shows months of inventory and months of shadow inventory, and how there was a lot of inventory up until 2011, and then now there's less inventory and the homes are not staying on the market as long. Let me get to the... Okay, here's one of the slides I wanted to spend just a few minutes on. This is talking about home appreciation. And this last slide down here, this shows you at the different price points, which I think is interesting. It's showing that this is as of March 31st of 2015, so this is the first quarter of this year. You can see that the 100,000 or less home prices, the number of transactions have actually dropped by 9.3%. But as you get in the higher price ranges, the number of transactions has actually gone up to where when you're looking at $1 million or better, the number of transactions has gone up by almost 8%. This is over last year. And again, this is national, but it's just showing you that the higher price range properties are actually selling at a higher rate right now.
Is this 9.3% decline in the under $100,000 value property?
And that's not value, that's number of transactions.
Oh, number of transactions.
Yeah. So the number of transactions in that price range are down about 9.3%.
But I still have the same question though. Is that because there just aren't as many homes under 100,000 anymore?
Quite possibly, yes. I think that would be a good reason.
Or
I
people
know.
are buying $200,000.
Well,
Yeah,
because
they can't
rates
find
are lower, more. I think that it looks like that it's about flat in the 100,000 to the 250,000. I think this is just my speculation, but I know at the below 100,000 for a while there were a lot of foreclosures that were at very low price points. And I think because there's so much fewer foreclosures now, I think we're seeing fewer homes priced in that price range. But again, this is number of transactions. So I'm just saying that the number of transactions have increased by 7.9% from the same time last year. Okay, this I found interesting, and it's talking about household formations. And when you think of household formations, I mean, you're talking about people potentially, getting married and forming a household and buying a home. But it also includes people who are graduating from college and getting jobs and buying their own homes as well. And if you look, it was at the peak around 2005, between 2005 and 2006. And then when you look at this big dip right here, that's when the recession hit. It was harder for people to find jobs. There were people graduating from college that couldn't buy homes, couldn't get jobs. They had high student loan debt. So that caused the household formation number to drop drastically, and then it's just been kind of bouncing around for the last 8 years, and they're showing that it's trended upward this year. So it's getting back up close to where it was at the peak back in late 2005, early 2006. Which is part of the reason for the increase in home sales and everything, exactly, because there are more what they call household formations, more people who have been able to get jobs and, possibly get married or just buy a home. Yeah, move out, exactly. That's what they mean, though, by formations. These are people who can now get their own place. So that is getting back up to where, towards the direction of where it was at the peak. All right. Talking about the fact that nationally home prices are currently undervalued compared to the long-term average, and this shows you where they've run. This is at zero here, so this shows when they were where they were above zero and then when they were below. So it's showing we're still 6.33% undervalued nationally. Okay, let me get to one more here. This is one graph I wanted to show you, and then I'll just end with this one. We talk about affordability and the fact that as interest rates go up, it's more difficult for someone to qualify for a higher priced home. And this illustrates the fact that with each 50 basis points increase, right here as the interest rates go up, well, let me explain what this number is here. I'm sorry. This is percent of a person's gross income. So they say average about 21% of someone's gross monthly income is their mortgage payment. Okay, so that's what this line is right here. For a while, people were buying above that rate, and then it's kind of dipped below as far as what they've qualified for. But if you see right here, this is kind of where we are right now because houses have been more affordable. But for every 50 basis points increase, and what that means in a mortgage rate is 50 basis points is usually 1/8 of a point in rate. So as the rate goes up by 1/8 of a point, it gets you up to here. So it makes the mortgage a little bit higher as a percentage of your income. This would be 100 basis points increase, so that means if rates go up by 1/4%, then this is a 200 basis points increase, so that would mean rates would have gone up by about 1/2 percentage point, and again, that makes a difference. It gets it a little bit above what the average has been over this time period. So it just shows you the homes are a little less affordable as we go up in rate. So we're looking at 1/8, 1/4, and then 1/2 point increase. All right. I know it's a lot of information. I just wanted to get this up here for you to see it, and I gave you copies. If you would like to get copies of this, I'll be happy to have this emailed out to you if you want to share it with any of your clients. All right. Thank you. Any questions? Thank you. Yes. Yeah.
And this is just kind of general. At what rate do the mortgage lenders feel like it starts choking off the market? You saw 5 on there. Historically, 5 is a good rate.
It is.
But historically, people's history has been the last 10 or 15 years, and that's not a good rate.
That's what the problem is. I know when rates started hitting 4.5% in the last couple of years, and I had people complaining about that. I'm like, I bought my first house at 15.5. Yeah. Rates are still fantastic. Really, historically, anything below 6 is a really good rate. But I think as they increase it, it's going to scare some folks, and hopefully they'll hurry up and buy something. I don't know, but there's always, as rates go up, there's always going to be people that are going to need to buy homes. It's going to, decrease what they can qualify for. And I think looking at, kind of, again, historically, what the mortgage as a percent of income has been, you can see during this time period here, when rates were actually a bit higher, people were still buying homes. It was just higher as a percent of their income.
They were speculating too.
Yeah. You had a lot of adjustable rates during this time period too. But I think again, during this time period, people were taking bigger risks. This was during the time period where mortgage companies were letting folks have a higher debt-to-income ratio. But when you start factoring in student loans and car payments and all of that, there's really a hard stop at 43 on some products, 44% on others at the debt-to-income ratio. We're back during that time period. You may have had people at their housing ratio being at 28 to 30%, but they were allowed to go up to 50 to 55% debt-to-income ratio, which was just insane.
But
So,
back then, we had no docs in a lot of
Right.
cases. So
Yeah,
that's
that's
not even
Stated
accurate. It
income.
probably was higher than that.
yeah, it was higher than that in some instances. This would have just been what we knew, but yeah. The loans where people were just stating their income, they could easily have been at a higher debt ratio than that, but it wasn't proven, so it wasn't known. Okay, thank you.
Thank you, Donna.